Hello, everyone. My name is Eric Evans, and I'll be your presenter. For this topic today, we're covering sensitivity analysis for capital budgeting. And for my presentation, I'm going to take a spin on it as we're looking at a case study so we can apply sensitivity analysis for budgeting for a fictitious company called GameSphere Studios. All right, so we're going to get into our topic. First, we're going to cover our table of contents. So the first topic we're going to cover is what is sensitivity analysis? Second, GameSphere Studio case study. Third, key variables for analysis. Fourth, sensitivity analysis result. 5, risk mitigation strategies. And 6, incorporating risk into capital budgeting. So we get into, what is sensitivity analysis? And that's the topic we're going to cover. What is sensitivity analysis? So basically, it's like a decision-making tool. Sensitivity analysis is a financial tool used in capital budgeting to evaluate how changes in key variables or assumptions affect a project's financial performance, such as net present value, internal rate of return, or payback period. Now, if we look at our diagram, we have tools. We have critical risk with capital budgeting. So for tools, these tools are going to basically, it says to tools to assess the impact of variables change on a project's outcome. So a project is always faced with different variables that will constantly change. And we need to assess that because that impact may be positive or negative. And we look at our critical risk. This helps identify critical risk factors in decision making. So there are just like tools, there are critical risks that we must actually investigate before we take one step forward. And then we have capital budgeting, which applied in capital budgeting to evaluate the financial viability. Is this a good financial move to make on, say, we're talking about this fictitious game? Do we invest money into this project or not? So go back to what we were talked about, the sensitivity analysis. Basically, it's a decision-making tool. And it's going to help us understanding risk and uncertainties associated with a project by showing the impact of very critical inputs like costs, revenue, interest rate, and production levels. All right, so let's get into our second topic. This is a GameSphere Studio case study. So again, like I said, we're talking about the game studio as a case for this presentation. So we have our game studio case. And the first thing we look at is the project. Okay, we're developing a new video game called Quest of Legends. This is, like I said, this is a fictitious company, but we're going to set on this adventure to create a new game. And we need to look at different aspects of it before we start to actually go forward. We know that our initial investment is going to need at least $5 million in development costs to create this game. And usually games take about 3 to 5 years to actually develop. So actually doing these drills to make sure that nobody wants to waste $5 million and you get halfway through the project or you're at the finish line and then you find out it's not going to be successful. So then on the next one, we're going to look at key metrics. We have net present value, and we have internal rate of return, and then we have payback period. So if we look at our net present value, the definition says the sum of the present value of all cash flows and outflows related to a project, discounted at a required rate of return. So let's look at this. We have an example so we can put this in perspective. So let's say this is our project. We have a project, and the initial investment we have is $5 million and is expected to generate cash flow of $1.5 million per year for 5 years at a discount rate of 10%. Now, the net present value will decide if the project is profitable or is not. We need to decide that, and that's how we'll use the net present value for that. Now, for our internal rate of return, let's say that in its definition says the discount rate at which the net present value of a project equals 0. And it indicates that the project's return as a percentage. Our example we're looking at is if the internal rate of return of our game, Quest Legends, is 15%, and the company is required a required rate of return is 10%. The project is financially attractive because we a gain of 5%. But if it was lower, that may not be attractive. If it was under, say it was 5%, we're actually losing. And then last, we're going to look at our payback period. And the definition for this is the time it takes for a project to recover its initial investment from cash flows. And it measures the risk and liquidity of a project. Okay. And then our last one we're going to talk about, we'll cover, and later on is our focus, analyzing the impact of key variables, sales volumes, and pricing. So if we look at our last little small illustration, it says, how should we analyze Quest of Legends project? And you have the little illustration of the guy, he's thinking. We got to think about the financial measures, the net present value. We have to worry about the internal rate of return. We have to worry about the payback period. And then also we need to investigate. We have to understand the impact of variables like sales volume and pricing on our project success. So we're going to get into more of the variables in the next lesson. Lesson 3, key variables for analysis. So our key variables for analysis, we have our development costs, as we established that we had our initial investment of $5 million. That's our base. And then we have our sales volume. That is the base case of 500,000 units, varying by plus or minus 20%. So we have 5,000, we're either going to increase our units as we're producing these games, or we're going to lower the production units that we have. Maybe the game's not going to be that popular. We don't anticipate that. And then lastly, we have our game pricing. So the base price, $60. That's pretty much the going price right now. Some games are $70, but that can vary. It says vary by 10% or below 10%. Some games, depending on the amount of production that went into it, they may not actually need to cost $60. You can probably get away with $45. Or you may have some really expensive AAA titles that are commanding above that at 10% more, at $70 per game. That's pretty expensive for some buyers, but some people are willing to pay for that if it's the value proposition is there that I think I can spend the money for it. All right, next we're going to look at our marketing budget. Our marketing budget is $1 million critical for boosting sales. So in order you got to have a marketing team in order to advertise so people know that this game is out there. You have to spend money. You're going to be putting ads on different social media platforms. You're going to be you have game trailers where showcase what's the game or game's capabilities, a sneak peek, a teaser to get everybody interested in it. And then later on, you start actually showing the actual game mechanics. This all costs money. So you have to have a marketing budget, a large marketing budget. So you won't develop a game that no one knows about. It might be the best game possible, but no one knows about it. They won't buy it. And then you have your royalty fees, 30% of sales revenue paid to digital stores. So what is a digital store? You have Steam. That's an online digital platform that allows players to download games, especially for PC games and stuff like that. Then you have, if you were going to app stores like Google Play or Apple Store, and you have a mobile game, Apple may command 30% of those sales, of each sale. So you have to price your stuff appropriately. All right, so now we're thinking about our next topic is sensitivity analysis results. So after all that we've talked about, this is our sensitivity results, that, hey, our sales volume impact, it might be 20% above change or below. this could really impact our sales if we don't sell at this price point. And if we do not, then we may not break even. We at least want to break even, but the ultimate goal is to make a profit and to satisfy our shareholders. And then the next one is game pricing impact. You got a moderate profitability impact, 10% above, 10% below. Pricing games is very important because some buyers will not shell out the extra $10 to buy a game that they think is not worth it, especially if the consensus is on social media saying this game is not good, or this game shouldn't be at this price, or do they have microtransactions baked into the game? Some players, they're willing to spend $5 or $10, but some players may not. And then our developmental costs, will it run over? Is it slightly a net present value reduction? So a lot of these games take a long time, 3 to 5 years to develop, and it could go over budget. And going over budget, you're encroaching on your own profits. So you want to stay on budget. So you really want to scrutinize all the things that you're doing so you won't make any mistakes. So we have an example. If we have our sales and they drop by 20%, our net present value is going to be a negative thing. And it's going to indicate that this is a high risk venture. We don't want that. So we really have to take a look at this closely. So next we're going to talk about our risk mitigation strategies. So we have our sales volume. We're thinking about increasing market efforts, expand our target audience. So let's say we are focusing on males. Okay, mostly males, but actually we need to look at females. The females are also playing video games also. And if you look at platforms like Twitch, you have a lot of streamers and not just all males. They're females and a certain age demographics. And then we also look at game. We talked about it before. We're talking about game pricing. Conduct market research to set optimal pricing. So if you have a first-person shooter, and most first-person shooters are, say, $60, and you want to go $70, you really have to prove that this game is worth $70 to the actual users. Because if they don't think the value's in there, you won't be able to sell that game, and you might not even break even. So we look at our developmental costs. Implement strict cost control. You definitely want to do this. You don't want to go over your development cost. It could be detrimental for the game, and it could be at the end of the cycle, the game could have blown that way past budget. And if you don't make those sales or that game flops, then you took on too much risk. Royalty fees. Negotiate better terms with digital platforms. This is, yes, you could or could not, depending on the type of game you have. Companies like Apple are pretty rigid. They're not really flexible with that. So if we look at our last little diagram, it says how to mitigate risk in game development and sales. All right, so you can increase your marketing efforts. We talked about that. Expand your audience and boost sales. So definitely expand your audience. Go beyond what your normal demographics are. But at the same time, stay within your niche, that people that like this. You might pick up a new group of folks that are into this type of game. Definitely conduct your market research. Ensure optimal game pricing. Make sure you price it appropriately. And implement cost controls. Reduce development costs. Negotiate your terms. All right, lastly, we're going to talk about incorporating risk into capital budgeting. So we look at our diagram. It says how to incorporate risk into capital budgeting. We have to adjust our discount rate, which reflects risk levels in the project evaluation. So you want to make sure that we're taking on an appropriate amount of risk. Risk is good. It's not a bad thing to take on risk, or that should not be scared of, but you have to understand the amount of risk that you're willing to take, and is it detrimental or not. And then we go back to our sensitivity analysis. Enhances the project evaluation of accuracy. Is this viable? And third, we have our scenario analysis. Project changes in multiple variables. And then last, we have our visual tools. Communicate findings effectively to stakeholders. So if you have stakeholders, everybody has to buy on this project. And if you don't explain it well, then your team won't really understand. They won't have a good buy-in on this. Having small meetings, showing the progress, showing that we are moving in the right direction. Or maybe we're not. Maybe we need to take a step back. Maybe we need to change directions. Okay, so that concludes this. It's a short presentation about this, and we have our references. And if you want to know more about where a lot of this information came from, you can look up the references about where we have capital budgeting, definitions, methods, and examples. And then what is sensitivity analysis? And we have risk and game development and what is sensitivity analysis. I hope you all enjoyed this presentation, and I hope it's impactful. If you are in the game industry and you want to be able to develop games, hopefully that you'll be able to take a look at this before you take a big leap into, taking out a $5 million investment and then put it toward developing, and this game should not be developed. All right. Thank you all for listening.